In today's video, I'm going to teach you how to use Thinkorswim Probability Analysis. We'll start right inside the Thinkorswim platform. From the main workspace, head to the top menu and click the Analyze tab. In that menu, choose Probability Analysis. This is the tool that visualizes the market's expectations for where a stock price could be in the future based on implied volatility from options. Once the page loads, you'll see a chart that looks like a cone or curved band fanning out into the future. That's where we'll focus. Next, enter a symbol. In the symbol box at the top left, type a stock ticker such as AAPL or any symbol you want to analyze. As soon as you enter it, the probability chart will load automatically using current market data. You don't need to press anything else. If the chart seems blank at first, give it a second to populate. It's pulling in live pricing and volatility. Now, let's read the chart. The horizontal axis, or x-axis, represents days into the future. As you move to the right, you're looking further out in time. The vertical axis, or y-axis, shows the stock's potential prices. The curved shaded area in the middle is the projected price range with a chosen probability. You'll notice that the shape widens as you go farther out. That's normal. Uncertainty grows over time, so the possible range expands. Think of the center as the market's consensus path and the edges as less likely outcomes within the probability you've selected. This isn't a prediction or a guarantee. It's a statistical model derived from what the options market implies about volatility. Around earnings or major events, you may see the cone widen more dramatically, reflecting higher expected movement. You can refine what you're seeing by adjusting the probability range at the top of the chart. Set it to 68% to view approximately one standard deviation of expected movement. This shows the range the stock may stay within about 2/3 of the time, offering a tighter, more focused band. Switch it to 95% to view about two standard deviations. That creates a wider cone, capturing more of the less likely, but still plausible outcomes, the tails. Use 68% for a concise view when you want a quick read on typical movement, and 95% when you want to account for broader risk scenarios. Remember, higher percentages mean wider ranges and more conservative expectations. That's all there is to it. Open probability analysis, enter your symbol, interpret the axes and shaded cone, and adjust the probability range to match your needs. Practice with a few symbols to build intuition, and let the chart guide your sense of potential price paths over time.